All right, so you want to know how these global banking regulations are impacting the world of digital finance.
Yeah, it's a question we get a lot.
It really is. And we're going to unpack it all today,
We are.
looking at Basel III and the digital financial revolution, understanding the impact.
Great source.
It is. And trust me, this is one deep dive that could change how you view your entire portfolio.
I think so.
It's not just about banks anymore.
No.
This framework, born from the 2008 crisis, is reaching into crypto, fintech, even those shadow corners of finance that are giving everyone a little bit of deja vu.
Yeah, what's really fascinating is that Basel III isn't just about preventing another 2008.
Right.
It's changing the DNA of finance, impacting everything from how banks lend to the types of assets that are considered safe.
So it's not just a Band-Aid on a broken system.
Oh.
It's a whole new set of blueprints.
Exactly. Basel III has 3 core pillars.
Okay.
And they're all designed to make the financial system more resilient.
Okay.
The first is all about capital requirements. Specifically, we're talking about the CET1 ratio.
Which is?
That's the common equity tier 1 capital,
Okay.
which jumped from a mere 2%
Under the old rules.
under the old Basel II rules to a whopping 7% now.
Wow. Okay, so break that down for me.
Sure.
What does that actually mean for banks?
Okay.
And why should I, as an investor, even care?
Well, think of it this way. Banks are in the business of lending money.
Right.
The higher the CET1 ratio, the more of their own money they need to hold in reserve for every dollar they lend out.
I see.
So this jump from 2% to 7% means they're playing it much safer, especially when it comes to riskier ventures.
Okay.
And as an investor, this affects you because it influences where banks choose to put their money,
Right.
which ultimately impacts which sectors of the economy grow
Right.
and which ones struggle,
So less risky lending, potentially less growth,
potentially.
but hopefully a more stable system overall.
That's the trade-off.
Okay.
The second pillar of Basel III is all about liquidity.
Right.
They introduced the Liquidity Coverage Ratio, the LCR and the Net Stable Funding Ratio, the NSFR,
So these are like,
basically stress tests
okay.
to make sure banks have enough readily available high-quality assets to weather a 30-day crisis.
So no more scrambling for cash when the market takes a nosedive.
Exactly. It's all about making sure banks have a buffer,
Uh-huh.
a cushion of assets they can easily convert to cash if things go south.
Okay.
And finally, the third pillar is enhanced risk management,
Okay.
especially for those complex derivatives that got us into trouble back in 2008.
Right.
Basel III demands much more sophisticated risk assessment
Yeah.
and stronger safeguards to prevent those domino effects that can cripple the entire system.
Okay, so we've got banks building up their reserves, shoring up their liquidity, and being extra careful with risky investments.
Right.
But now let's bring in the elephant in the room.
Okay.
Cryptocurrencies.
Right.
Where do they fit into this fortress of financial regulations?
Yeah.
Are they being welcomed with open arms or treated like the Wild West?
That's the million-dollar question.
It is.
And the answer is complicated.
Right.
When it comes to unbacked cryptocurrencies like Bitcoin and Ethereum,
Yeah.
Basel III is taking a very cautious approach, even skeptical, some might say.
Okay.
They slapped these assets with a 12,250% risk weighting.
Whoa.
That's essentially saying banks need $1 in reserve for every dollar of Bitcoin they hold.
Wow, that's a serious risk premium.
It is.
It sounds like they're almost trying to discourage banks from getting involved with crypto altogether.
It's definitely a signal that regulators are concerned about the volatility and the potential systemic risks associated with cryptocurrencies.
Yeah.
They want to protect the traditional banking system from those wild swings we've seen in the crypto markets.
I see.
But it's not a complete shutdown
Yeah.
when it comes to stablecoins. Things get a bit more nuanced.
Okay, so let's talk stablecoins.
Let's do it.
Everyone's saying they're the key to mainstream crypto adoption.
Right.
Is Basel III giving them the green light?
It's more of a yellow light with some conditions. Basel III divides stablecoins into 2 groups.
Right.
Group 1 stablecoins
Uh-huh.
are those that meet strict criteria for stability and transparency,
Okay.
like being fully backed by reserves and having clear mechanisms to maintain their peg to a fiat currency.
So these are the good guys,
These are the good guys.
getting more favorable capital treatment.
Exactly.
So less of a burden for banks to hold them.
Exactly. But then there's group 2,
Okay.
stablecoins that don't meet those high standards.
Right.
They get lumped in with the unbacked cryptos and face that same hefty 1,250% risk weight.
So Basel III is essentially picking winners and losers in the stablecoin space.
It is.
I bet this has massive implications for investors, right?
Absolutely. This is influencing which digital assets gain institutional acceptance,
Yeah.
which ones are being integrated into traditional financial products, and ultimately which ones are likely to see wider adoption and potentially higher return.
And on that note, we are going to wrap up part 1 here.
Yeah.
But when we come back, we're going to pick right back up talking about the impact of Basel III extending far beyond the world of crypto.
Sounds sad.
Welcome back to our deep dive into the world of Basel III.
It's like we're peeling back the layers of a financial onion.
We are.
And each layer reveals new complexities.
Absolutely.
And challenges.
Yeah, and some might say a few tears along the way as well.
Yeah, true.
But you're right. This isn't just a one-time fix.
No, it's not.
Basel III is a constantly evolving framework, adapting to new technologies.
The ever-shifting landscape of finance.
So let's talk about those adaptations.
Okay.
What's on the horizon for Basel III?
Oh.
What changes should we be keeping an eye on?
One of the most significant areas of focus is the treatment of digital assets.
Okay.
Remember that eye-popping 1,250% risk weighting for Bitcoin and Ethereum?
I did.
That's not set in stone.
Really?
As regulators gain a better understanding of these assets and how they behave in the market, we can expect to see adjustments to those risk weightings.
So could we see that number come down?
Potentially?
Maybe even see some crypto assets being treated more favorably under Basel III.
It's certainly possible.
Okay.
Regulators are grappling with this dilemma.
Which is?
How to balance the potential benefits of crypto.
Yes.
Like increased efficiency and financial inclusion with the inherent risks.
Right.
They're looking for ways to create a more nuanced approach that doesn't stifle innovation while still protecting the stability of the system.
It sounds like they're walking a tightrope.
Yeah.
Encourage innovation on one side, maintain stability on the other. Not an easy task.
Not at all.
What about stablecoins?
Sure.
Any changes on the horizon for how they're treated under Basel III?
Stablecoins are definitely front and center in the regulatory debate right now.
They are.
They're designed to be less volatile than traditional cryptocurrencies.
Right.
Pegged to a stable asset like the US dollar.
Okay.
And because of that perceived stability, they're seen as having the potential to revolutionize payments and cross-border transactions.
So are regulators warming up to the idea of stablecoins being integrated into the mainstream financial system?
I think it's more of a cautious optimism.
Okay.
There's a growing recognition that stablecoins could offer significant benefits, but there are also concerns about their potential impact on monetary policy and financial stability.
Right.
So the focus now is on developing robust regulatory frameworks that address these concerns while still fostering innovation in the stablecoin space.
So it's not a question of if stablecoins will play a role,
Right.
but how they will be integrated into the financial system.
Exactly.
That makes sense. But let's not forget about the rest of the fintech world.
Sure.
Are there any Basel III adaptations on the horizon that could impact those companies?
One area to watch closely is the evolution of open banking and the rise of banking as a service, BABA platforms. As these models become more prevalent, regulators are likely to revisit the rules around data sharing, customer protection, and the allocation of responsibility between banks and their fintech partners.
So it's not just about regulating the banks themselves.
Right.
It's about ensuring that the entire ecosystem, including those fintech collaborators, operates within a safe and transparent framework.
Precisely, the goal is to foster a dynamic and innovative financial landscape while mitigating potential risks. It's about finding that balance between fostering innovation and maintaining stability.
Yeah.
The same challenge we see with crypto and stablecoins.
It's interesting how all these threads seem to be woven together: innovation, regulation, risk. It's all interconnected.
It really is.
But speaking of risk, we can't forget about those players operating outside the traditional banking system.
Right.
Those lurking in the shadows. Are there any regulatory moves afoot to bring shadow banking more under control?
There's definitely a growing focus on strengthening oversight of shadow banking activities. Regulators are working to increase transparency, improve data collection, and develop more effective tools to monitor and mitigate risks emanating from this sector.
So it's like shining a light into those dark corners of finance, trying to get a better handle on what's happening and where the potential vulnerabilities lie.
Exactly. And this is where international cooperation becomes even more crucial.
Right.
Shadow banking activities often transcend national borders, making it essential for regulators to work together to develop consistent standards and prevent regulatory arbitrage.
Speaking of regulatory arbitrage, are there any strategies being considered to close those loopholes and create a truly level playing field?
One approach is to harmonize regulations across jurisdictions, reducing the incentives for financial institutions to shop around for the most favorable rules.
I see.
This requires close collaboration between international regulatory bodies and a commitment to establishing common standards.
So it's about getting everyone on the same page, making sure the rules of the game are consistent no matter where you're playing.
Precisely. And it's not just about closing existing loopholes.
Right.
It's also about anticipating future challenges. As technology continues to evolve at a rapid pace, regulators need to be proactive in identifying potential risks and developing appropriate safeguards.
So it's like a constant game of catch-up, trying to stay one step ahead of those financial innovators who are always pushing the boundaries.
It's a challenging but essential task.
It is.
The goal is not to stifle innovation, but to ensure that it occurs within a framework that promotes stability and protects the interests of consumers and investors.
This all raises an important question. What are the implications of all this for investors, businesses, and policymakers? How should they be navigating this complex and evolving landscape?
For investors, it's crucial to understand the regulatory backdrop and how it might impact different asset classes and investment strategies. For example, as regulators refine their approach to digital assets, it will create both opportunities and risks that investors need to carefully consider.
So it's not just about picking the next hot stock. It's about understanding the regulatory forces at play and how they might shape the market landscape. It's about being a savvy investor, not just a lucky one.
Exactly. And for businesses, particularly those in the fintech space, it's essential to stay informed about regulatory developments and to proactively engage with regulators to help shape the rules that will govern their operations.
So it's about being a part of the conversation, not just reacting to the rules as they come down the pike.
Yeah.
Be proactive, not reactive.
Exactly. And for policymakers, the challenge is to strike that delicate balance between fostering innovation and mitigating risk. It's about creating an environment where new technologies can flourish while ensuring that the financial system remains stable and resilient.
It sounds like a tall order, but it's absolutely crucial to get it right.
It is.
The stakes are high, and the decisions made today will have a ripple effect for years to come.
Indeed, and it requires a collaborative approach, bringing together experts from industry, academia, and the regulatory community to develop thoughtful and effective solutions. It's not about one side dictating to the other. It's about finding common ground and working together to shape a financial future that benefits everyone.
This all leads to a broader question. What does the future hold for the relationship between regulation and innovation in the financial sector? Will they continue to be adversaries, or can they find a way to coexist and even complement each other?
That's the ultimate question, isn't it? And the answer, in my view, lies in finding a way to move beyond the traditional adversarial dynamic and to embrace a more collaborative approach. Regulation should not be seen as a barrier to innovation, but rather as a framework that enables responsible and sustainable growth.
So it's about moving away from that image of the regulator as the heavy-handed enforcer, instead seeing them as a partner helping to guide innovation in a direction that benefits everyone.
Exactly. It's about recognizing that regulation, when done thoughtfully, can actually foster innovation by creating a level playing field, building trust, and mitigating risks.
That's a powerful insight. So as we wrap up the second part of our deep dive, it's clear that the interplay between Basel III and the digital financial revolution is far from over. In fact, it's just getting started.
Indeed. And as we move into the final part of our discussion, we'll explore some of the key takeaways for investors, businesses, and policymakers. And we'll leave you with some provocative thoughts to ponder as you navigate this rapidly evolving landscape.
Welcome back to the final part of our deep dive into the world of Basel III and its impact on the digital financial revolution.
It's been quite a journey.
It really has.
Yeah.
I have to say, it's been fascinating to see how these regulations are shaping the future of finance.
It really highlights how interconnected everything is and how even seemingly small changes in one part of the system can create ripple effects across the entire landscape.
Exactly. So let's bring it all home. What are the key takeaways our listeners should walk away with from this deep dive?
Right.
What's the so what of it all?
Well, first and foremost, understanding Basel III is essential for anyone involved in finance.
Right.
Whether you're an investor, a business owner, or even just someone trying to make sense of the global economy.
Right.
It's not just about banks anymore. It's about understanding how these rules are influencing the entire financial ecosystem, from crypto to fintech to the rise of shadow banking.
So knowledge is power, right?
Absolutely.
The more you understand how these forces are interacting, the better equipped you'll be to navigate this complex landscape and make informed decisions.
100%. It's crucial to recognize that Basel III is a work in progress.
Okay.
It's not a static set of rules, but rather a dynamic framework that will continue to evolve as new technologies emerge and new challenges arise.
So it's like a living, breathing organism,
Yeah.
constantly adapting to the changing environment.
That's a great way to put it. And this means we need to be prepared for ongoing adjustments, refinements, and potentially even major overhauls of the framework in the years to come.
This raises a really important question.
Yeah.
How can we ensure that these adaptations
Yeah.
are made in a way that balances the need for stability with the drive for innovation?
Right.
How do we keep the financial system safe without stifling the creativity that drives progress?
This is where collaboration becomes absolutely crucial.
Yeah.
We need a dialogue between regulators, industry experts, and academics to ensure that the rules are both effective in mitigating risk and adaptable to the ever-changing realities of the financial world.
It's about finding that sweet spot, that delicate balance
Right.
where regulation provides a safety net
Right.
without stifling the creative energy that drives progress and leads to new solutions.
Exactly. And the third key takeaway is that we can't ignore the unintended consequences of regulation. While Basel III is designed to make the system safer, it's also creating incentives that are pushing risk into less regulated areas like shadow banking.
It's like squeezing a balloon.
Yeah.
You might push the air out of one part, but it just pops up somewhere else.
That's a great analogy.
It is.
And this highlights the need for constant vigilance and a willingness to adjust the rules as new challenges emerge. It's a dynamic process.
It is.
And we need to be adaptable and responsive to ensure that the regulatory framework is keeping pace with the evolution of the financial system.
So we've got our key takeaways. Knowledge is power.
Right.
Basel III is a living, breathing thing.
Yes.
And unintended consequences are always a possibility.
Always.
But before we wrap up, I want to leave our listeners with something to ponder, a final thought to spark their curiosity
Okay.
as they continue to explore the world of digital finance.
Here's a question to chew on.
Right.
Could Basel III, in its attempt to prevent a repeat of the 2008 crisis, inadvertently be sowing the seeds of the next financial crisis?
Ooh, that's a good one. By pushing risk into less regulated areas, are we simply delaying the inevitable?
Yeah.
Or are we creating a system that's fundamentally more resilient?
Only time will tell.
It will.
But by understanding the forces at play, by engaging in informed debate, and by embracing the ongoing interplay between regulation and innovation, we can increase our chances of navigating the future of finance successfully.
Well said. And that, my friends, brings us to the end of our deep dive into Basel III and the digital financial revolution. We've explored the complexities, the challenges, and the opportunities that lie ahead. We've looked at how this framework is reshaping the financial landscape, and we've left you with some thought-provoking questions to ponder as you continue your own exploration. Thanks for joining us on this deep dive. We hope you found it as insightful as we did.